Beneath Florida's glittering sun and swaying palms, a silent disaster is brewing. Thousands of brand new homes, once symbols of prosperity, now sit eerily vacant. Over 30,000 statewide, with some cities seeing price drops of $70,000 or more. Builders are panicking, slashing prices, offering $25,000 incentives, and throwing in everything from free pools to mortgage buydowns. But it's not working. Incomes can't keep up with $3,200 mortgage bills and $6,000 insurance premiums. The Florida dream is fracturing. Welcome to the Sunshine State's darkest secret. 10 cities where the housing bubble has burst, and the American dream is turning into a $400,000 nightmare. Number 10. Spring Hill. Spring Hill, once a quiet Hernando County suburb, is now one of Florida's most alarming flashpoints in the 2025 housing bubble. Just a few years ago, this area saw a construction boom fueled by investors and developers hoping to cash in on the Tampa spillover demand. But that surge has backfired. In 2025, Spring Hill has amassed a staggering 6.2 months of new home inventory, more than double the normal healthy level of 3 months. This glut is most visible in sprawling subdivisions north of County Line Road, where hundreds of identical spec homes sit unsold, with prices now slashed by up to $45,000 below their 2022 peak. The median price for new construction homes in Spring Hill once soared to $360,000, but by mid-2025 that figure has dropped to just $305,000, a 15% decline in less than a year. Builders are now offering aggressive incentives, $15,000 in closing cost assistance, free upgrades, and even rate buydowns to 4.99%, desperate measures to offload inventory in a cooling market. Despite these offers, buyers remain cautious, with mortgage demand in the region dropping over 35% year over year. The bigger issue? The local job market can't support these prices. Median household income in Spring Hill hovers around $57,000, making new homes grossly unaffordable without deep financing gimmicks. Meanwhile, investor activity has dried up entirely, leaving builders exposed. Permits for new construction have plummeted by 41% since early 2024. But the damage is already done. Spring Hill is stuck with hundreds of empty brand new homes no one's buying. With inflation biting into household budgets and Florida's insurance premiums soaring, Spring Hill's real estate market sits in a dangerous position. The bubble hasn't just formed, it's already leaking. And the silence on these empty cul-de-sacs? It's deafening. Number 9. Fort Myers. Fort Myers was once the darling of Florida's Gulf Coast real estate boom. Between 2020 and 2023, the area saw a 78% surge in home values as remote workers and retirees flooded the city, driving median home prices from $240,000 to nearly $430,000. Builders couldn't pour concrete fast enough. But by 2025, the dream is buckling under its own weight. Fort Myers now sits on over 2,300 unsold new construction homes, the majority priced between $420,000 and $550,000, far out of reach for most locals. With the average household income around $61,000, a 7% mortgage locks many buyers out. Builders in Fort Myers have responded with brutal price cuts, slashing new home prices by $50,000 or more, while offering free pools, appliance packages, and $20,000 in closing cost credits just to keep traffic coming into model homes. Even with these incentives, pending sales are down 43% year over year, and new listings linger on the market an average of 72 days, up from just 19 in early 2022. Worse still, the insurance crisis has hit Fort Myers hard, especially after Hurricane Ian's $100+ billion destruction. Premiums now average $4,200 per year, further pushing buyers away from the coast. Rental demand has softened too, with average rents for single-family homes down 18%, scaring off investors who once dominated the market. Construction permits have been cut in half, but it's too late. Entire subdivisions east of I-75 sit half-sold, eerily quiet. In Fort Myers, paradise has turned precarious. What was once a seller's goldmine is now a developer's nightmare, an oversupplied, overpriced market with falling demand and rising costs. The real danger? These vacant homes aren't just a glitch. They're the warning bells of a full-on Gulf Coast housing correction. Number 8. Davenport. Davenport, located just southwest of Orlando, once thrived as a vacation rental boomtown. Between 2019 and 2023, over 6,000 new homes were built here, many branded as short-term rental investments aimed at tourists and Airbnb entrepreneurs. But by 2025, the music has stopped. With tourism plateauing and regulation tightening around short-term rentals, Davenport now has one of the highest concentrations of unsold new builds in Central Florida. More than 1,500 homes, mostly in the $375,000 to $475,000 range, sit empty, designed for investors that no longer exist. The median price of new homes in Davenport peaked at $410,000 in late 2022. Today, it has slumped to $348,000, a steep 15% decline, while weekly price reductions flood MLS listings. Builders have grown desperate, offering $25,000 in incentives, 2-to-1 interest rate buydowns, and even live 3 months rent-free promotions. Yet buyers are scarce. Many locals earn under $50,000 annually, far below what's needed to qualify, even with creative financing. Davenport's Achilles heel is its over-speculation. Developers built assuming infinite demand from out-of-state landlords, but with platforms like Airbnb cracking down and tourism growth slowing, thousands of homes sit misaligned with local needs. Vacancy rates in vacation zones have doubled since 2023, pushing investors to offload properties in panic. As inventory bloats, home builders are halting new projects altogether. Permits are down 61%, and land deals have collapsed across Polk County. Compounding the issue are soaring insurance costs and HOA fees in these gated communities, often adding $500 plus monthly to housing costs. With inflation still high, families are pulling back on relocating to areas like Davenport, once considered affordable. What remains are unfinished cul-de-sacs and echoing silence in former rental hot zones. In 2025, Davenport is no longer Florida's Airbnb gold rush. It's a city caught in a speculative hangover, and it's not waking up anytime soon. Number 7. Port St. Lucie. Port St. Lucie exploded in popularity over the last 5 years, luring thousands of retirees and out-of-state buyers with promises of affordability and suburban peace. Between 2020 and 2023, the median home price jumped from $245,000 to $410,000, a jaw-dropping 67% increase. But the rapid appreciation triggered overbuilding. By 2025, the city is choking on over 2,800 unsold new homes, especially in Tradition and St. Lucie West, 2 master-planned zones now dotted with vacant driveways. Median new construction prices now hover around $395,000, but builders are slashing up to $40,000 off, asking prices while throwing in full appliance sets, fenced yards, and $18,000 in closing help. Still, demand has cratered. Monthly pending sales are down 46%, and resale homes are undercutting new builds by wide margins, often by $25,000 to $35,000. One major issue is affordability. The average household income in Port St. Lucie is about $62,000, but with mortgage rates near 7%, monthly payments now exceed $2,800 with taxes and insurance. That's just not sustainable, especially when homeowners are now paying $4,000 plus per year for insurance due to flood zone risk and aging infrastructure. Investors have also pulled back. Single-family rental yields have dropped to just 4.2%, making it unattractive to hold newly built homes. As investor appetite vanishes, builders are left scrambling to sell to real families, who are increasingly priced out. Meanwhile, construction hasn't stopped fast enough. Although permits have declined by 37%, many developments are still pushing forward due to contracts signed years ago, adding more units to an already saturated market. This mismatch between supply and local demand is sending Port St. Lucie into housing purgatory. In 2025, sunshine and palm trees can't hide the harsh truth. Port St. Lucie is stuck with too many homes, not enough buyers, and a housing bubble ready to pop. Number 6. Lakeland. Lakeland once thrived as Central Florida's sweet spot. Halfway between Tampa and Orlando, it promised affordable homes and commuter convenience. But in 2025, Lakeland's housing market is bloated beyond belief. With over 2,400 unsold new homes flooding the market, the area now holds one of the state's highest oversupply ratios relative to population. Builders chased speculative demand, flooding North Lakeland and South Polk County with sprawling subdivisions priced between $360,000 and $460,000. But now, streets are lined with for-sale signs and tumbleweed-level foot traffic at open houses. The median new construction price has fallen from $395,000 in 2023 to $335,000 in 2023. 2025, a 15% drop. While builders offer everything from $25,000 in incentives to mortgage rate buydowns to 3.99% just to move inventory. Yet buyers are hesitant. Lakeland's median household income sits around $58,000, and at today's interest rates, even entry-level homes stretch affordability limits. The commuter appeal that once drove demand is fading too. Gas prices remain volatile, insurance rates have doubled since 2022, and employers across Orlando and Tampa are scaling back hybrid policies. Fewer people are willing to deal with a 60-plus-minute commute just to live in an overpriced suburb that's losing its value. Meanwhile, the rental market has cooled, with monthly rents down 11%, causing investor pullback. Worse still, construction hasn't stopped fast enough. Despite a 48% drop in permits, builders are still completing homes started during the pandemic boom. The result? Empty neighborhoods with pristine lawns, silent driveways, and zero demand. HOA fees in newer developments, often over $350 a month, only add fuel to the affordability fire. Lakeland, once the budget-friendly commuter utopia, is now suffering the consequences of overzealous development. With demand fading and prices falling, the mirage has turned to mayhem. Number 5. Ocala. Ocala has long been billed as Florida's horse country and a retirement haven. Between 2020 and 2023, it saw a building spree targeting 55-plus communities, golf course homes, and equestrian estates. The problem? Developers built for the next retirement boom, but the boom didn't show up. As of 2025, Ocala is stuck with over 2,100 unsold new homes, particularly in retirement-centric subdivisions where prices once touched $420,000. Today, those same homes struggle to fetch $355,000 despite generous $30,000 incentives and zero HOA for 2 years promos. Local incomes are nowhere near enough to support the housing stock. With a median household income of just $50,000, many retirees or workers can't absorb the rising insurance premiums, which now top $3,800 per year, even in non-flood zones. Combine that with HOA fees for golf communities exceeding $400 a month, and you have a home ownership package that feels more like a luxury tax. Another challenge? Demand for retirement living is shifting. Today's retirees want walkability, healthcare proximity, and vibrant town centers, not just gated homes on sprawling land. Ocala, while scenic, lacks urban conveniences. That's left entire neighborhoods half-occupied, with move-in-ready homes sitting unsold for 120-plus days, a 4 times increase from just 2 years ago. Even more alarming is the construction hangover. Permit issuance may be down 35%, but existing pipeline completions continue flooding the market. In some tracts, builders are finishing 10 homes per week, yet selling only 1 or 2. The oversupply is rapidly devaluing existing properties and discouraging even cash buyers. What was once a booming retirement destination is now buckling under the weight of false expectations and a rapidly changing demographic reality. Ocala's market isn't just cooling, it's at risk of freezing. Number 4. Northport. Northport rode the post-pandemic wave harder than almost any other Florida city. Its affordable land and open zoning made it a playground for developers. By 2023, thousands of oversized single-family homes flooded the landscape, many built without clear end users. Fast forward to 2025, and Northport is staring at over 3,000 unsold new builds, with homes priced from $400,000 to $550,000, a bracket far above local affordability. Median household income here hovers around $59,000, but with mortgage rates above 6.5%, the average monthly payment now exceeds $3,000, well beyond what most families here can handle. Even dual-income buyers are opting out, especially with insurance premiums in the region skyrocketing to $4,500 per year, thanks to proximity to high-risk flood zones. Builders are in triage mode. They're cutting prices by $60,000, offering solar panel packages, free upgrades, and $20,000 in closing help. But still, sales are painfully slow. Days on market have ballooned to 96 days, and investor demand has all but disappeared due to poor rental yields under 4%. Many of the homes were built with square footage in the 2,500-plus range. Massive spaces that don't align with the needs or budgets of today's downsizing retirees or first-time buyers. That mismatch has led to entire subdivisions sitting half-completed with construction paused mid-phase. Some developers are even walking away, leaving infrastructure unfinished. Despite a 54% drop in building permits, the damage is done. Builders rush to meet speculative demand that no longer exists. Now Northport is paying the price: falling home values, ballooning inventory, and a crumbling reputation as a safe growth market. Northport isn't just oversupplied, it's misaligned with reality. The dream of family-sized homes at affordable prices has turned into a bloated market few can afford and fewer still actually want. Number 3. Lehi Acres. Lehi Acres was supposed to be the budget alternative to Fort Myers, a place where families and investors could find space, affordability, and long-term growth. But in 2025, Lehi has become one of Florida's most dangerously oversupplied housing markets. Developers jumped in with full force between 2021 and 2023, adding over 4,000 new homes, many of which now sit unsold and empty. Some blocks have more vacant homes than occupied ones, a chilling sign of a deep housing imbalance. The median new construction price in Lehi Acres once hovered around $340,000, but in 2025, it's been chopped down to $285,000, a 16% decline. Builders, desperate to clear inventory, are throwing in $20,000 price cuts, appliance packages, and mortgage buydowns to 4.75%. But affordability still doesn't match local income. With median household earnings at roughly $52,000, even discounted homes require buyers to stretch dangerously thin. What makes Lehi Acres especially risky is its lack of infrastructure. Many of the new homes are built on isolated streets with no sidewalks, no sewer access, and limited road maintenance, making them difficult to sell or finance. Insurance rates have climbed to over $4,000 annually, and local property taxes have also risen, leaving buyers overwhelmed by total monthly costs. The investor market has all but vanished. Renters can't support high returns, and single-family rentals are sitting vacant longer. Builders have slowed permit requests by 60%, but there's a massive backlog of half-finished projects still hitting the market. Lehi Acres is a case study in speculative overbuilding without the job base, infrastructure, or population growth to support it. As 2025 unfolds, the city faces not just a market correction, but a harsh reckoning with unrealistic development dreams. Number 2. Palm Bay. Palm Bay was one of the hottest post-pandemic markets in Florida. Drawn by affordability and a surge of Space Coast job growth, developers flooded the area with thousands of homes. But now, in 2025, Palm Bay's real estate market is showing unmistakable cracks. There are over 3,200 unsold new construction homes, and more are still being completed. Builders overestimated the pace of growth, and now they're left with streets full of vacant houses and no buyers to fill them. New home prices hit a high of $385,000 in late 2022, but by 2025 have fallen to an average of $328,000, a 15% price correction that's left early buyers underwater. Builders are slashing prices by up to $40,000, offering $25,000 in cash incentives, free fences, and even temporary rate buydowns to 3.99% to lure hesitant buyers. But demand remains soft. Palm Bay's median income is around $56,000, which doesn't support monthly mortgage payments nearing $2,500 once taxes and insurance are factored in. Rentals aren't faring much better. Average rents are down 12% year over year, and rental yields have dipped below 4.5%, forcing investors to pause purchases or dump homes. Vacancy rates are climbing in key zip codes, especially in new subdivisions on the west side. Permits have slowed, but homes from previous building booms are still hitting the market. And buyers are growing cautious amid rising insurance premiums, many paying $3,800 to $4,400 annually, especially as severe weather risks grow. Palm Bay's story is classic. Too much enthusiasm, too little long-term planning. With prices falling, unsold homes piling up, and affordability strained, Palm Bay isn't the futuristic growth corridor anymore. It's a warning sign flashing bright for all of Florida's mid-tier cities. Number 1. Cape Coral. Cape Coral tops the list as Florida's most dangerously oversupplied housing market in 2025. Often dubbed the waterfront wonder, Cape Coral was ground zero for the post-COVID housing gold rush. Builders capitalized on cheap land and canals to construct thousands of new homes, many in the $420,000 to $600,000 range. But fast forward to today, and the city is drowning in over 4,500 unsold new construction homes, the largest new home glut in the state. Prices are crashing. The median new build has dropped from $465,000 to $395,000, a 15% decline, and homes are sitting on the market for over 90 days on average. Builders are panicking, offering $30,000 in discounts, $20,000 in closing cost help, and even boat packages for canal homes. But none of it is working fast enough. Cape Coral's average household income of $61,000 can't keep up with monthly costs nearing $3,200, factoring in mortgage, taxes, and insurance. Insurance premiums have exploded here, reaching $5,000 to $6,000 annually, thanks to hurricane risks and rising flood zone designations. Even homeowners who bought in cash are now looking to sell, unable to absorb the skyrocketing insurance and HOA expenses. Rental markets aren't bailing out the situation either. Rents are down 14%, and many new builds designed as vacation rentals are sitting empty. Investor interest has collapsed. Permits are down 58%, but the supply pipeline is still flooding in. Many subdivisions are less than 40% occupied. Some homes are being relisted multiple times with price cuts exceeding $70,000. Cape Coral isn't just correcting, it's unraveling. What was once marketed as Florida's coastal crown jewel is now a cautionary tale. Too many homes, not enough buyers, and no easy way out. If there's one city where Florida's housing bubble may truly burst, it's here.